Good morning. My name is Maurice Crespi, Managing Partner of Schindler's Attorneys, co-founder of COBRA. We are dealing today with tax under COVID-19, under the present climate. We are joined today by my panelists, Graham, who will be leading the show today. He'll be taking us through the landscape that has just emerged in relation to the various tax consequences and the relief that's been afforded to businesses. We have Carl, also from the Sudar Group, Bob from IQ Business Group, Emma from IQ Business Group, Dominique Lloyd from Schindler's Attorneys, and Peter Gordon from Engaged, Ian Fleming, the CEO of Engaged Business Turnaround, Artisha from IQ Business, and Dean Wright from Schindler's Attorneys. So I'll introduce the host. His name's Graham Saggers. He's the tax director and he's the national head of tax for Nolans. He's a chartered accountant and has a master's in South African tax from the University of Cape Town. He's passionate about consulting on all aspects of tax and has presented locally and internationally on various topics. From this webinar, Graham hopes to assist you guys in understanding tax-specific COVID concessions, including how to calculate ETI incentives and what the amendments mean for your provisional tax calculations this year. Over to you. Thanks, Graham.
Thanks, Maurice, and welcome everyone. Thanks for having me here. I'm going to share my screen now so that you can see I've got a PowerPoint presentation that we can work through. Okay, so just in terms of what we're going to cover today, we're really going to focus in on the, as Maurice said, the tax-specific concessions that have been announced as part of the COVID-19 relief measures. And these are really focused on three specific concessions. So the ETR, that's the employment tax incentives, the increases in those, the pay-as-you-earn deferral, which we'll go into a bit of detail, and the provisional tax deferral. And then I've also just put together a few frequently asked questions that we've been getting within our firm on things that are really concerning taxpayers out there, and we'll open up for question and answers a bit later. So just as a kind of overview of key initiatives that have been announced. So from a labor perspective, what's been getting a lot of press is the temporary employee relief scheme. So I am going to touch a bit on that in the FAQ section. I'm not going to go into detail on it because it's more of a labor law issue than a tax issue, but it is something that we're certainly dealing with a lot. So I'm going to mention one or two things on that a bit later. Then we're going to focus on, as I mentioned, these three tax-related concessions. And then just to bear in mind that there are other initiatives that have been announced, which I'm sure have been discussed at some point through various webinars on both the financing side and other kind of social welfare type side of things. The first aspect that I want to go into detail on is the employment tax incentive and expansion. So in order to understand what's been released, we need to first look at what the current situation is. So the employment tax incentive was something that was released in 2013. It's considered something to stimulate employment in youth. It's a so-called youth wage subsidy. How it works is it's a credit on a company or an employer's pay-as-you-earn liability. So it's important to understand that it's not an incentive to the employee, it's an incentive to the employer. It's focused on if you have employees that are between the ages of 18 and 29 and have a monthly remuneration of less than 6,500. So that's why I say it's an incentive on the employer, because people are earning less than 6,500 generally are below the taxable threshold in any case. So you're not actually withholding any pay-as-you-earn from them. But what you do is, what you get for each of the people like that you employ is you get a credit against your pay-as-you-earn liability that you would have accumulated or accrued on your other employees. So it's a direct benefit to the employer. It's a credit of your liability that will go onto your income statement as effectively a tax exempt incentive. So how it works is there are three categories of calculations that I've mentioned there. This is the current situation before the COVID incentives. And there are a few other more technical details which I don't have time to go into detail in order to comply with ETR, such as minimum number of hours employed per month. You must be paying employees at least the minimum wage and those sorts of protective measures. But how it works is there are three categories of remuneration. So between 0 to 2,000 Rand a month, you get incentives based on the percentage of your remuneration. Then between 2,000 and 4,500 Rand a month, it's a flat amount, 1,000 Rand for the first 12 months and 500 Rand for the second 12 months. And then between 4,500 and 6,500, it's another formula which kind of decreases as you get closer to 6,500. So in terms of the COVID-19 proposal, this was first proposed to be an incentive of an extra 500 Rand per employee that's on the ETR scheme. This was later increased to 750 Rand, but it's not as simple as just saying each person gets 750 Rand. So you'll notice this table in the bottom left-hand corner has changed a bit. For people that are already on the scheme, in the first bracket, you get a straight extra 750 Rand plus the normal calculation. In the second row, the 2,000 to 4,500, again, an extra straight 750 on that flat amount. And then in the third category, the formula has changed somewhat so that the incentive you get would decrease a bit. And I've got some examples later to work through these. What's been interesting is it has now opened up the scheme to people that ordinarily wouldn't qualify for the employment tax incentive. So these are people that have claimed ETR in the past. So those who are between 18 and 29 years of age, who are no longer eligible because they have already claimed them for the full 24 months. So ETR normally only applies over a 24-month period. So if you've finished your 24-month period, you can now, for this limited period, claim an extra amount. And then also for those people that are between the ages of 30 to 65. A question we often get asked is, what about foreign employees? So this does apply if they have refugee status or if they are permanent residents in South Africa. So if they've got a South African ID number, you can claim. Okay, so this is just zoomed in on that other table that I showed you. It's very important to understand that what we're seeing, a lot of employees are fitting in the third category, the 4,500 to 6,500 Rand remuneration. So there is a formula to be applied. We've got, which I'll chat to Maurice and Carl afterwards if we can share. We've got a simple Excel tool that you can use if you like to help understand, which employees can be claimed and help you calculate these formulas. So a quick example, if we consider 3 examples of employees who are in their first year of employment and would ordinarily qualify for the employment tax incentive. So if we assume employee A earns 1,500 Rand per month, they would fit into that first category. So under the normal ETR Act, they would just get 50% of that as an incentive. Whereas now under the COVID-19, over the next 4 months, they would get an extra 750 Rand, so 1,500 Rand per month. Employee B, assume he earns 3,000 Rand per month. So he would fit into the second category. So normally that would be the flat, easy calculation of the 1,000 Rand per month, whereas now it's 1,750 Rand per month, flat amount. Employee C, if she earns 5,000 Rand per month, it's a bit more of a complicated calculation. So ordinarily you would apply the 0.5 times your monthly remuneration less 4,500. That would get you to 750 Rand per month. So as you can see, it starts decreasing from the 1,000 Rand. Under COVID-19, the formula has changed. So it's 1,750 minus 0.75 times your monthly remuneration. So that would get you to 1,375 Rand per month. So very important to apply the formulas. And this table is just to show how the formulas change for those employees that have now been introduced into the employment tax incentive that ordinarily wouldn't qualify. So these are those that I mentioned earlier that are between 18 and 29 and have already claimed their 2 years, or for those that are between 30 and 65. So if their remuneration's between 0 and 4,500, it's a flat 750 Rand per month for the next 4 months. So that's an easy calculation. And then for those between 4,500 and 6,500, again, there's a formula applied. So based on the formula, the ETR incentive would be somewhere between 750 Rand per month and 250 Rand 25, depending on what the remuneration is. Obviously, if they earn more than 6,500, then there's no incentive. Let me keep my chat open here. Okay, the pay-as-you-earn deferral. Oh, there's the chat. Okay, I'm going to go through the pay-as-you-earn deferral now. Right, so the proposed relief measures is an employee tax deferral of 35% of the employer's total tax liability. So again, over this 4-month period from April to 31st of July 2020. So who qualifies? It's any employer. So it's not limited just to companies, as was initially thought by some people. So it's any company, trust, partnership, or individual who is registered as an employer. They must have been registered, though, by the 1st of March 2020. So it excludes people that have, only registered after that. The gross income of the employer should be 100 million Rand or less during the year of assessment ending on or after 1st of April 2020, but before 1st of April 2021. Okay, so this is very important for a few reasons. One is, in a lot of the speeches, they've mentioned turnover less than 100 million. It's not turnover, it's actually gross income. So gross income includes your income from other sources, not from turnover. So if you are earning any passive income from interest, or if you've got rental income, or for those individuals, if you are conducting a trade where you are an employer but are also earning remuneration, all of those would both be brought into the 100 million Rand determination. And also that gross income from other sources, so non-turnover income, must not be more than 10% of your total gross income. Okay, so some very important considerations there if one is looking at applying these. Most companies or most taxpayers in South Africa are on a 28 February year end. So this is going to apply for the 100 million Rand limit. It's going to apply for your 28 Feb 2021 year end. So that's obviously quite a far way away. So if you are considering this and you think you may be kind of on the brink of that 100 million Rand turnover, then you need to pay very careful consideration to it, and obviously look at, watch your income very closely. If you're getting to the beginning of next year and you think you're going to hit that 100 million Rand, then you need to take into account potentially losing the relief, or ensuring your 100 million, your turnover or gross income remains below the 100 million. Very important, the employer must be fully tax compliant. So what we're saying to all our clients or anyone we get queries from is, before you submit your EMP 201 on any of these periods, just log into your e-filing and check your tax status. So you can check tax status live on e-filing now. So it's no longer a matter of getting a certificate that lasts a year. So go in and either download your tax compliance certificate on that date or take a screenshot, anything to just prove that you are tax compliant when you're submitting the EMP 201. So what is the actual relief? So it's 35% of the pay-as-you-earn liability can be deferred for April, May, June, and July. So your pay-as-you-earn liability for April, for example, is paid on or before the 7th of May. So it was only this May period was the first pay-as-you-earn period that this deferral would have applied to. Importantly, it's 35% of the pay-as-you-earn liability, so not the total liability on your EMP 201. So only the pay-as-you-earn portion, excluding skills development levy and your UIF contributions. So no admin penalties and interest will be imposed for the deferred payments. And what we've been seeing is SARS is giving taxpayers the benefit of the doubt when applying this. So automatically, when you submit your EMP 201 and pay short, there's no additional liability that's popping up on your statement of accounts. It's giving you the benefit of the doubt that you are going to match the criteria, but obviously, that needs to be monitored. And then what they are going to do is during the August month is they'll calculate what all the deferrals have been and then apply on your statement of accounts 6 equal payments that must then be made over the next 6 months. So you get the deferral for 4 months, and then what you've deferred needs to be paid over 6 months in equal installments. So what's very important is this deferral relief doesn't affect your liability that must be declared on your EMP 201. It's only affecting how much you actually have to physically pay across. So you declare your EMP 201 as per usual, and then you just only pay 65% of that amount. The due date for the first payment, as I said, the 7th of May. And then if you at a later stage realize that your declaration was incorrect and you submit a correction, then obviously there'd be penalties and interest on the additional liability where you've made that mistake. So on this slide, we've got an example of different liabilities amounts. If the liability is fluctuating each year, the deferral amount is up each month. The deferral amount is going to obviously fluctuate, but then in the 6 months starting from August, you would then need to pay that equal installment each month, which SARS will calculate for you. So just some further considerations. So obviously SARS can't verify the 100 million gross income requirement now because that's only relating to the year that you're currently in. So if you then exceed the 100 million at a later stage, you'd lose the relief and you'd be charged penalties and interest back from the original EMP 201 dates. So just a practical note we put in there is just whatever payroll software company you're using, just check with them how this is affecting their lives and if they're making any amendments, but it's unlikely because the actual EMP 201 remains the same. It's just the payment amount that gets reduced. We're expecting a new EMP 201 format any minute, but we haven't yet seen it. That probably will come into play by the next month, because only from next month, so from your June period, the skills development levy holiday, which I'll mention a bit later, will come in. And then just a more practical note, if any of your employees do get remuneration or amounts from any of the COVID-19 disaster relief trusts, so if any of the amounts are received from an approved COVID-19 disaster relief trust, that is excluded from remuneration, so not taxable. Okay, I'm going to move on to the provisional tax. I haven't seen any questions pop up. Okay, on the provisional tax side, so the Here's questions. So I'm going to move on to the provisional tax deferral. Just a few notes on provisional tax in general before we move on to the COVID-19 relief. The one important thing that we always talk about on provisional tax is the concept of basic amounts. So what we found a lot of people do, especially for first provisionals, is they will just take their previous year's assessed. And that would be considered your basic amount, and then just use that as the estimates. We don't like this approach. We like taxpayers to make a clean estimate each provisional tax period. If it is then less than your basic amount and you've got justification, you can declare a provisional tax payment of lower than your basic amount. But if it's more, we prefer taxpayers to actually submit their estimated liability, not just their previous years, because it's justifiable and it means you're making a serious estimate. So our approach is estimate your tax liability, compare it to your basic amount, and then when you submit your RP6, when you do your provisionals, you would do them based on your estimated liability and not on a percentage of estimated liability. So what some people like to do is work out their estimated taxable income and then only declare, say, 90% of it or 80% of it to get them out of that penalty territory. We prefer to just rather submit the full amount. The COVID-19 proposal, so obviously provisional tax payments for 28 February year-end taxpayers, your first provisional tax payment would be due now in August, with your second one in February next year. So it's your February payment that's normally where you really need to make sure you're accurate, because that's when a potential penalty could arise. But what the COVID-19 proposal is that if you, again, have a gross income of less than 100 million Rand for the current financial year that you're in, and again, same requirements, you don't have more than 10% of that from passive income, and you tax compliance, then if your first provisional period is during the next 4 months, between April and 30 September, then in that period, you'd only pay 15% of your annual liability instead of 50%. And I'll walk through an example in a minute to show you how that all plays out. For second provisional periods ending over the next year, so 28 Feb 2021 will come into this, you pay 65% of the total annual liability instead of 100%, less any payments made as part of the first provisional payment. So what this means is that by the end of Feb, or by the end of your financial year, you should only have 35% of your estimated annual liability still due, and that can then be paid in your third provisional period, your top-up period. So either if you get your tax return in within 6 months of the financial year end, either in your final tax return, or if you take longer than 6 months, then you'd pay a top-up within 6 months of the end of your financial year. Okay, similar to the employees tax, you must declare your full estimated liability on your RP6, and then you only pay the reduced amount. So you don't declare a reduced amount, because that may give rise to an under-declaration and underestimation penalty, which can be quite punitive. Okay, so I've got 2 examples that I'm going to work through here. I realized that on a previous webinar I did on this, that I confused people a bit with the 65% and 15% aspects. So I'm going to try kind of clarify a bit of that. So scenario 1 is a bit more straightforward than scenario 2. So if we assume that a taxpayer is a company that's fully tax compliant across all tax types, they have a February financial year end. As at 31 August, they come along for their first provisional payments. They're estimating that their annual turnover to be 65 million, and they estimate their profit before tax to be 10 million. What they would do in August is they would take their estimated profit of 10 million. The tax on that would be 2.8 million, 28% of that. And then they would only have to pay 15% of that as part of their provisional payment, so that 420,000. When they then come to their second provisional payment in February next year, their gross income has dropped a bit to 55 million with profit before tax of 8 million. So again, they would take their 8 million, times it by 28% to give you that 2.24 million. Then in that February payment, they're only required to pay 65% of that. So 65% of the 2.24 less their August payments. So the 420,000, which would give them 1.036 million. So as you can see, their February payment would actually work out less than 50% of what you would normally, normally you'd pay 50% in Feb. It actually works out a bit less because they paid more in August. But importantly, their third top-up payment would then be 784,000, which is effectively 35% of their total liability. So whichever way this goes, your final third payment would be 35% of your total taxable amount. Scenario 2, I just wanted to highlight the importance of getting your estimates right. So if we say, similarly to the first one, in August, a taxpayer's gross income is 85 million with the estimated profit before tax of 10 million. Their first provisional payment is going to be the same as in scenario 1, so 420,000, which is 15% of the 2.8 million tax estimated. But if they now come to February next year and realize that somehow they've managed to have a bumper year in these circumstances and their turnover exceeds 100 million, so 110 million, they're going to lose their total relief. So their estimated profit's 8 million. They would have to, by the end of February, have paid the full 28% of that 8 million, so 2.24. Obviously, they would still less their first provisional payment, so the 420,000. So their second provisional will be quite high at 1.82 million. So that's really just showing, both the benefit of the relief and the importance of getting your estimates, especially of that 100 million, right. This is just a comment from us. If in that situation, if they didn't get the relief, SARS are fully entitled to go back to their first provisional payment and query it and ask them to prove how they thought they were able to qualify for the relief. And if they can't justify their approach, SARS would be fully within their rights in the Tax Administration Act to increase their first provisional payments and charge them interest on any short payments. So, with this unusual circumstance we're in with COVID-19, I think one needs to view SARS in the same light as any business out there, in that they are going to be cash strapped, and we're expecting in the second half of this year that we're going to have some quite interesting disputes on our hands. So I think it's very important to make sure that you're very careful with any of these estimates and make sure that you do qualify and are able to apply them correctly. Because if you make a mistake along the way, I don't suspect we'll get much leniency from SARS. Okay, I'm going to work through some of the frequently asked questions and Q&A. So the first thing I just wanted to work through was just to maybe as a bit of background to understand where we are in the whole sort of legislative process. So every time a new law is introduced, it needs to be introduced as part of a bill, which then goes out to public comment. Once that whole process is complete, the bill is tabled in Parliament, which is then promulgated and becomes an act. So from a tax perspective, there were bills released at the end of March, which were available for public comment. Those bills have now been amended for a new round. That public comment period ended on 30th of April. So we're expecting a lot of these to be enacted as soon as Parliament's reopened. So a lot of what we've spoken about isn't law yet, but it can be applied as if it is law. So after the speech by President Cyril Ramaphosa when he announced that it wasn't the one he was announcing the extension of the lockdown, it was the speech to announce the economic stimulus package. He made some tax-related points in there, and then on the 23rd of April, National Treasury released a media statement with a whole lot of more incentives in them. So I want to just work through a few of those because a lot of them are important for us. So the first one that bears mentioning is they've announced that they're postponing the implementation of some of the budget 2020 measures. So in the budget presented at the end of February, Minister Mboweni announced that there will be certain measures that they will introduce through tax law amendments during the year. So the ones that we saw the most amount of attention from are they want to restrict interest deductions to 30% of earnings, and also limit the use of assessed losses carried forward. So currently, if you have losses carried forward from previous trading, you can offset it against your current year profits. They want to limit that to only 80% of current year profits. So if you are in a profitable position, you'll always be having to pay some amount of tax, depending, despite what your historical losses are. That was supposed to be effective from 1 January 2021, and this has been postponed to 1 January 2022, so a bit of extra relief there. They announced the increase in the expanded employment tax incentive amount, so that was just moving from the 500 that was first announced to 750. Similarly, the changes in the pay-as-you-earn deferral. So in the first round of concessions, the limit was 50 million. That's been increased to the 100 million. And initially, the pay-as-you-earn relief was 20%. That's been increased to the 35%. And they mentioned that a lot of people are asking what happens if we are a company that exceeds 100 million or doesn't qualify for any of these relief packages, but we are struggling. They said there'll be a case-by-case application to SARS for waiving of penalties, and I'll explain a bit later what that means practically. The big one is skills development holidays. So your skills development levy is 1% of your payroll each month. They've granted a holiday on that for the next 4 months. So what's good about this is it's a holiday. It's not a deferral of liability. So employees will not have to pay that SDL for the next 4 months. So the first time this applies is for your May payroll, so your payment due in June. And practically what they've said is on your EMP 201, the SDL block will automatically show null. So you won't be able to change it. So that SDL holiday applies to all employers, no matter what your turnover is or what your gross income is. Fast tracking of VAT refunds. So VAT refunds is obviously a contentious issue, and I'm intrigued to see if this does actually happen as promised. But what they've said here is if you're a smaller VAT vendor, so if your turnover is less than 30 million a year, you'd only submit VAT returns every 2 months. For the next 4 months, you can submit VAT returns if you want every month. So if you are a smaller VAT vendor that is usually in a refund position, by submitting every month, you can get your refunds every month. Practically, we see that more often than not, if people are in a refund position, they get audited, and it can take some time for the refund to come out. But we have, heard through other channels from SARS that these will be fast-tracked and they will come through quicker. There's a 3-month deferral for carbon tax. There's a deferral for excise taxes on alcoholic beverages and tobacco products to grant some relief to those industries who are obviously struggling at the moment. And then more on some individual factors. So they increased the deduction available for donations to the Solidarity Fund. So usually for a taxpayer, or company taxpayer, if you make donations to a public benefit organization, you get a tax deduction for them, which is limited to 10% of your taxable income. That will be increased by an additional 10% if you make donations to the Solidarity Fund. So they're obviously trying to stimulate some donations there. There is a method where you can encourage employees to donate to the Solidarity Fund, and they won't have to pay as you earn on those donations. And then the last point there, which I find quite interesting, is for the next 4 months, if you are recipients of a living annuity, normally you can only change the amount that you draw from the living annuity once a year, and your limit's between 2.5% and 17.5%. For the next 4 months, you can change that immediately. You don't have to wait for the annual anniversary, and that can be increased to 20% or drop to 0.5%. So it allows a bit of flexibility on your financial planning side. More for interest sake, I've included a table there to show that they're expecting that these relief packages will provide relief of approximately 70 billion rand to the general public. So this is 70 out of that 500 billion that Ramaphosa announced. Okay, so some of our frequently asked questions we're getting is there an allowance for the deferral of VAT payments in instances that either customers have not paid us or we're unable to calculate the VAT payments as we don't have access? So the short answer is no. None of these relief measures are related to VAT. If you're under cash flow strain, you can apply to SARS. There is a section in the Tax Administration Act which says if you get a late payment penalty and you can prove that your reasons is because of exceptional circumstances, which includes a state of disaster, then they must provide that relief. But obviously, you need the onus is always on the taxpayer to prove that your situation was affected by the disaster. If you're unable to, we've had clients say to us, look, like all our records are sitting in the office and we're not allowed to go to the office at the moment, so we don't know how to calculate our VAT payments. Then the best thing you can do is estimate it, provide an estimate, and then correct it once you can know those amounts. But don't just declare nothing. We've had some people ask that are importing goods that are exempt from paying VAT on importation. So I haven't gone into detail on, or I haven't touched at all on customs, but some of the sort of emergency goods like face masks and that sort of thing you're not required to pay VAT on importation. But if you import them, you'll get the VAT relief on the import. But if you're then supplying them into the local market, you must still charge VAT on that because that's now a domestic supply. So there were questions around ETI. There were some views in the market that employees must have been employed subsequent to 2013. That's not accurate. So this ETI incentive is available to all employees that earn less than 6,500. Obviously, the age requirement's still there. Bizarrely, they still have it's effectively between 18 and 65. So if you have employees older than 65, they're not going to be able to comply. COVID-19 relief funds are effectively private funds that have been set up as public benefit organizations in order to provide assistance to small businesses. So the more well-known ones are the ones set up by the Ruperts and the Oppenheimers. So effectively, any payments received from those would be tax exempt. What relief is there for businesses with gross income exceeding 100 million? So this was asked of SARS a lot, and they've set up two different email addresses where taxpayers can apply directly. Obviously, whenever applying for any of these, it's in your best interest to get all your paperwork and documentation in place to show that you have been affected by COVID, and then SARS will consider certain, deferred payment plans or compromise arrangements. There's no separate registration required for ETI. You don't have to register as an ETI employer. It's available to all employers. And then, as I mentioned earlier, the SDL holiday is available to all employers, so not just those below the 100 million. Okay, this is just a summary of all the measures that we've put out. before I kind of finalize and open up to more discussion or frequent or questions, I just wanted to touch on, I said I'm not going to deal with the UIF matters, the temporary employee relief scheme, but it has been getting a lot of attention. So I just wanted to clear up a few things. The one thing that's happened is, so basically how the temporary employee relief scheme works is if companies or employers have been forced to temporarily close their business, they can provide for relief from the UIF. So this sits separate from normal UIF claims. So if you temporarily close down, but then after the lockdown period, you permanently close down and retrench staff, that would be a different claim. But the temporary employee relief scheme is you would basically submit amounts to the UIF, and they would pay either the employees directly or the company on behalf of the employees a percentage of their salary. And they've got a formula for calculating how that works. The minimum amount they would pay is 3,500 Rand. And then the maximum amount is about 6,700 and some change, depending on the employee's individual salary. So what a lot of people are doing is claiming that, and then the employer would actually top it up to get them back to their normal salary. And what we were finding, and we got notifications from the South African Institute of Chartered Accountants, is that the way the UIF were calculating it is if employers then topped it up, they would deduct that from the UIF payment. So then people would end up receiving nothing. They have corrected this, and they have explicitly stated that employers can do top-ups. And what they've also said is if you're in a situation where a lot of people were at the end of April, where they had submitted TERS claims but hadn't received them yet, you can advance funds to your employees, and you have a loan agreement between them, and then once you get the TERS claim, you just offset it against theirs. So what's very important with this is if there are payments that are coming directly to the employers, not to the employees themselves, then you need to be able to show proof that the amounts paid were effectively paid through to the employees. They won't just hold on by the companies. So the UIF will be conducting audits on, I think at the moment they're just trying to pay as much out as quickly as possible, and then they're going to go back and audit and make sure that everything was paid out correctly. So that's really the one point I just wanted to make on the TERS scheme, is that you can do the top-up arrangements, and what's becoming popular is people actually just helping the employees by advancing them amounts, and then the next month offsetting the TERS claim, and then paying them their remuneration and the pay-as-you-earn related to that. Cool. So that's me and my team. If anyone's got any other questions. If not, Maurice, I don't know if you want to jump in, or should we open up to the floor and see?
Yeah, I don't know if any of the panelists have any questions. I thought because we have a bit of time and COBRA is about rescuing companies, we may ask Peter just to give us some insight into SARS's attitude when it comes to companies and business rescue or in distress, and maybe also deal with the reporting obligations of a business rescue practitioner, and how that's tied in. So what's it like on the ground, Peter?
Maurice, morning to everybody. Mixed from SARS. I'm dealing with one at the moment where we went through a formal settlement process, signed agreements in, I think, November, and we're still battling to get payment. We were promised yet again tomorrow that they're going to get, yesterday rather, that we'll get payment. So that's not a good story. But on other ones, on VAT, in a VAT reclaim position, I've had an example of somebody submitting on Friday and having cash in their bank on Tuesday. So I think, as Jeff was saying, they are trying, I suspect, but it is a bit of a mixed bag. Persevere. If you are having challenges at SARS, do come into COBRA with an inquiry, info@cobra.org.za. With your inquiry, and somebody will get back to you. And we obviously in contact, as I'm sure Nolan's are as well, with the folk at SARS, especially the large business centre, and we're quite happy to pick up queries.
Yeah, and I think it's an important point to make, is that COBRA we have these experts available at your disposal. This is South Africa's biggest corporate pro bono initiative, and today gives you a taste of the level of expertise that is made available to businesses in distress. And just over back to you, Graham, on the question of SARS, and how have you experienced them? How have they been?
Sure. We've experienced actually like quite a quick turnaround time on a lot of our queries, which has been quite like confidence building for us, which has been good. We haven't had too many report backs on the VAT refund side, so that example that Peter gave now was quite good. But certainly on queries and looking for clarification on things, we've experienced some quite quick feedback, which is always helpful. I'm expecting that we through like people mostly understanding the pay-as-you-earn deferral things, and I'm expecting we're going to have a bit of issue when it comes to provisional tax period, and the second half of this year I'm expecting some issues with SARS.
I'm going to ask you a difficult question. Nolans are known for being absolutely brilliant when it comes to their tax advice and coming up with creative schemes and coming up with creative solutions. Now, have you guys been looking at any of these tax regulations in the context of possible avoidance schemes, tax planning, and that kind of stuff? Or have we not got there yet? Or have any of your clients actually asked, is there an angle here?
No, excellent question. Yeah, look, the tax avoidance thing is quite, it's a very interesting question, because tax avoidance kicks in when the sole or main purpose of your decision is to save tax. So you always need to have a commercial justification for it. So in that, there's an opportunity, because if the commercial reason for your decision is to save your business or to help your business thrive, there's a very strong case for making any decisions that you make. But that being said, the question, whenever I raise that with someone, they immediately come back to me and say, but saving tax is commercial. I'm not paying less tax, but that obviously is not.
Well, I think what you guys are doing, why the level of expertise of the Nolans is required, is because it's not only about there's the relief, and then there's the advice on the efficiencies and how to actually implement the regulations in the most efficient way. So I'd imagine that's like there's another component that is going to endure for some time, and I'd imagine you guys will be pretty busy.
Yeah, absolutely. No, definitely. And I mean, our general kind of principle, especially on these deferral type things, is, tax deferred is tax saved. Rather have the money in your account. So if you are going to qualify for it, even if you're not struggling financially, defer your pay as you earn, because it's going to buy you a bit of extra time with money in your account to do other things. If you're not struggling, if you're fortunate enough to be in that position. But yeah, our overriding principle is, compliance first. So really make sure that you do qualify, but then absolutely take advantage of everything and anything that's out there.
And when it comes to big business, what's the attitude there? It's just it's just a focus on the smaller businesses.
Yes, I mean the big business aspect is frustrating. I mean, for example, we've got clients that are car dealers that have an inflated turnover because they operate on quite a thin margin. I mean, their turnovers to get over 100 million as a car dealer is not too difficult, but they obviously their cost of sales is high, and they technically aren't going to qualify for a lot of these. So in those instances, the best you can do is just just reach out to SARS and come up with a proposal to them on how, if you are struggling to meet your payments, how you propose deferring it, or and we've seen some creative things, like people looking at like offsetting some of their payments against like an assessed loss brought forward, which SARS are open to. They are negotiable these things. There's a question come through here, which is another thing that's popping up a lot. There's a lot of financial assistance for salaried employees, but nothing on commission who are only earning. That's probably the hardest question that we're getting asked at the moment, because a lot of the financial assistance measures are very exclusive of sole proprietors. You know, they're focusing on companies, and, you know, something as simple as needing a CIPC number in order to apply is quite prejudicial against sole proprietors. So unfortunately, you know, from a SARS perspective, the only real benefit is if you're conducting a trade, potentially a deferral of the provisional tax that I mentioned. But on financial assistance, the best people can do is literally go through each of those financial assistance, you know, all the disaster relief trusts, and look at all of them individually to see where potentially there could be some relief there.
Yeah, and let me mention, COBRA set up a knowledge base on the website www.cobra.org.za, and we've now been told that it's actually the most comprehensive and it's the best knowledge base in the country. It's also run by AI. It's got a search bot and what have you, so you can actually type a question in there and it gives you the results or the information required, because there's so many now. I mean, everybody seems to have come to the party, and it's a minefield. But you know, you can always reach out to COBRA and ask us to point you in the right direction. It takes one email, info@cobra.org.za. So please reach out. Are there any other questions? Please, guys, this is a webinar. The idea of webinars is to have questions so that we can actually deal with specifics in relation to you. Let's see this. Thank you.
Maybe I could just make a comment there on what Graham was saying. We've had a number of clients, and obviously we're just dealing with clients that are either in distress or about to go into distress. And a number of them that have got cash on the balance sheet have said not to worry about TERS or any other tax deferrals, because we've got money in the account, we're just going to pay it. That's not a clever thing to do. Really hang on to your cash. I think that's what Graham's mentioned there. Hang on to your cash. Assume that you're going to be in difficulty come 31 December 2020, if not into 2021. Do not assume that everything's going to be back to normal fairly rapidly. So please do hang on to cash. It is absolutely critical that you do so. And if you're getting relief from PAYE deferrals of that or your provisionals, please make use of it now. And, you know, Maurice, you advisedly used the word avoidance. There's nothing wrong with avoiding tax. There's tax evasion that we have to be careful of, because that's contrary to the law. But to avoid paying tax is absolutely lawful, and this is merely a matter of structuring your business affairs, knowing what you're going to go through or assuming what you're going to go through into the near future.
Great. I think that's it. We don't have any further questions, so we'll call it a wrap. To mention, we have these webinars all the time, every day, sometimes more than one a day. Like today, we'll have a webinar tomorrow. It's basically a weekly wrap-up by Sophie. So let me ask Carl, are you jumping in this afternoon?
I'm not sure if I'm on this afternoon, but I did just want to say thanks so much to Graham for stepping up and being part of this today and accepting the call. So thanks so much, Graham, for you and for the Nolan's team. They've been great friends of the Sadar Group over the years, as you all know, and really appreciate you being willing to do this for us today.
Yeah, just to mention for those who joined late, because you can watch this video again, and I see on the Facebook page it started a bit late, so the intro as to who the speaker was is not on the Facebook page. So if you joined late today, it was Graham Sagers. He's the tax director, national head of tax for Nolan's. So really, really insightful, and I'm sure we're going to have him back as we've had Carl. So thank you, everybody. Go to our website for further webinars, further details, and please let us know how we can assist. That's what we're here for. Thanks, guys. Thanks to my panelists. Until this afternoon.